So in this video, I want to turn to the problem of how we determine current cash profits. And current cash profits, or free cash flows to the firm, always start with revenues. This is the amount that the firm obtains from selling goods or services. Any model of value or any pricing model will start with what people often refer to as the top line, with revenue, the amount that you obtain from selling goods or services. You then deduct all of the operating costs from this initial revenue number. Now, those costs will include the cost of goods sold, but also advertising, all of the salaries that you pay to the employees of a firm, which often go under this general term of sales, general, and administrative costs. And another important component of costs will be depreciation. I will return to the issue of depreciation in a lot of detail when we discuss the Che Guevara case in week 2. If you take the revenue, you deduct all of these costs, you will obtain the earnings for the firm, but those earnings are determined before we have taken into account interest. That is an important component of cost that is not included when we calculate free cash flows to the firm. And we have also not yet taken into account taxes. Why do we not take interest into account? Well, that has to do with what we are trying to determine in the first place. In the title to this slide, it says we are trying to determine the free cash flows to the firm. Those cash flows are then distributed to debt holders in the form of interest or principal repayments, and whatever remains is owned by the shareholders. In what follows, we will always be focusing on valuing the assets of the firm. We will worry about dividing up the value of the assets between debt holders and equity holders later on. So it is important that what we obtain here are the earnings before interest, before we have deducted interest, and before we have taken into account taxes. Now, what do we do next? Well, we next consider taxes. And so we deduct the taxes according to whatever rate is appropriate in the country and in this time period. Okay? Finally, we have to take into account that in order to produce these earnings, the firm has to invest. And there are two main kinds of investments that we will be interested in. We will have capital expenditures. Those are investments in buildings or in cars and trucks or machinery. Those investments have the characteristic that they are not used up at once in 1 year. If I buy a building, the government effectively, the IRS, does not allow me to consider that a cost of the goods sold, because that building will be there for many years, and I will be using that building for many years in order to produce or to house my employees. So how does the cost of that building get reflected in the free cash flows? It gets reflected in depreciation. And so we will account for capital expenditures under this investment category. And then each year, we will consider a piece of that investment as a cost that gets reflected in the earnings before interest and taxes, as you see in this formula. The other big category of investment is net working capital. Net working capital includes operating assets and operating liabilities. So what is an operating asset? Maybe the primary example of an operating asset is inventory. If you think about a retail store that wants to start operating, in order to generate revenues, and then which will have costs as it operates, one of the first things that that retail store has to do is to build up inventory in order to meet demand of those that come into the store. We call that an investment in working capital, and in particular, an investment in operating assets. Again, you might wonder, but wait, you just said that you include the cost of goods sold as one of the costs. And that is correct. What is this investment then that we call changes in net working capital? Well, that investment only occurs when we set up inventory. Once the firm starts operating, it will start selling items from that inventory, and it will have to replace those items. And so that inventory from that point on may well not change if the firm is not growing any further. Now, each of those items that then get sold will be the cost of goods sold that we mentioned before. But the fact that we initially had to set up inventory is considered an investment. Now, importantly, that investment is not depreciated. It gets reflected in costs, again, through the cost of goods sold. Now, other operating assets include accounts receivable, though that accounts for the fact that customers will often not pay immediately. We may need to extend credit to the customers, and we call that accounts receivable. And then on the operating liability side, the most important component is usually accounts payable. Now, that reduces the amount that I need to invest in order to operate, because accounts payable is about credit that my suppliers have granted me. And so that reduces the amount that I will have to pay immediately for my inventory. So generally, net working capital is about operating assets minus operating liabilities. And as I pointed out before, what we care about in terms of investment in net working capital is the changes over time. Whether it be increases in net working capital, which we would consider an investment in net working capital, or reductions in net working capital, which would be a source of cash for the firm. Now, you will often see this formula that summarizes what I just said. Free cash flows are given by earnings before interest and taxes. If we go back to what I just said, that's that first piece that we started by computing, revenues minus a series of operating costs. That is earnings before interest and taxes, or EBIT. And then I multiply that by 1 minus the tax rate. Again, remember that the first thing that I did after computing earnings before interest and taxes was to deduct taxes to that amount. And that is what I am doing here by multiplying by 1 minus the tax rate. I then add back depreciation. Why do I add back depreciation? Because remember, I am trying to determine cash flows. Depreciation is not a cash cost. Depreciation comes about because at some point in the past, I bought a building, and then over time, I am recognizing the cost of that building, but I am not incurring any additional cash outflows for recognizing that cost. And so if I want to determine my cash flows, I will compute EBIT times 1 minus T, and I will add back the depreciation that I had included in earnings. And now you might ask, but why do you go through the trouble of first taking out depreciation from earnings and then adding them back when you're determining cash flows? And the answer to that is, as you may have guessed by looking at this formula, depreciation has tax implications. And so if I want to compute how much tax I owe, I need to take into account the fact that depreciation is considered a cost. So I need to include those costs, calculate the taxes, but then I recognize that depreciation is not a cash cost, and so I add it back when I am trying to determine free cash flows. After I've done that somewhat complicated computation, I then subtract capital expenditures. We've talked about those. Those are investments in long-lived assets. And we deduct changes in net working capital. So any investments I had to make into operating assets, be it inventory or accounts receivable, and deducting any increases in operating liabilities. It might be accounts payable, it could be taxes payable, any source of cash that I have that I do not pay interest on. So in sum, what do we have? First, valuation starts with cash profits. And that is what we are doing in the first two terms here. Earnings before interest and taxes, taking out the taxes, times 1 minus the tax rate, plus depreciation, because that is not a cash cost. And then I need to invest in order to generate profits. And that is what this formula is saying. I have to deduct capital expenditures, and I have to deduct the changes in net working capital. So valuation starts with cash profits, and I need to invest in order to generate those profits. Now, what does this not include? It does not include interest expenses. Again, we will return to that issue later. But for now, we are thinking about the value of the assets of the firm. We are not yet thinking about how to divide up that value between equity holders and debt holders. That's why for now, we are ignoring interest expenses. We are also ignoring dividends.